How's it going, everyone? Today we are going to go over SMT divergences, or smart money trading, smart money tactics, just the divergences. So let's get into it. Normally, the S&P 500 and NASDAQ track each other, as you can see right here. You can see this by looking at market structure, lower lows, lower lows, lower lows, lower lows, higher high, higher high, higher low, higher low. They aren't perfect, but the structure is similar. But sometimes they diverge and do different things. For example, one is making a higher high while the other one is making lower highs. As you can see, up to here, the market structure is the same. But if we look right here, what happens? The S&P is making a lower high while the NASDAQ is making a higher high. So this is a divergence. Now, if we look ahead, there's also another one from today. Right here, you can see the NASDAQ is making a higher low, while the S&P is making a lower low. This is also a divergence. So now that you understand what a divergence is and how to spot them, how do you trade a divergence? Ideally, you would like to see a grab of liquidity or some point of interest, right, for these to reach for looking for a divergence. Higher time frames are most likely going to be a little more reliable. I prefer the 15-minute chart, but I do use the 1-minute chart quite a bit. Which one do you take the trade on? Well, you want to take the one that is diverging. So if you are having a bearish divergence, or lower highs and higher lows, as shown here, you want to take the one that is making the lower high. For example, it would be the S&P here. You want to take the lower high because it is weaker. Now, if you have a bullish divergence, shown here, right, making lower lows and higher lows, you want to take the one that is stronger. In this case, the NASDAQ, since it was making a higher low, while the S&P was making a lower low. There are two ways you can trade the SMT divergences. We are going to go over the first one now. You can enter on the one that is diverging and risk the lows or highs. If these lows or highs are broken or taken, the divergence is invalidated and that will be your stop. For example, we have this divergence between NQ and ES here. Since it is a bullish divergence, you want to take the one that is stronger. Thus, you take NQ, making the higher lows. So what you would do is when you spot it, enter, risk the lows, and then have your target. You risk the lows because if price was to return and take out these lows, it's not a divergence anymore, right? Because that is what ES is doing. The next way to trade an SMT divergence is after you spot the divergence, look for a lower time frame entry on the 1 through 5-minute charts. You want to look for a market structure shift and a return to a fair value gap to get an entry. This entry is safer, but may not always present itself. So for example, looking at the same one as before with NQ, you want to take this because it is making higher lows. Now, you wait for a market structure shift here, get your displacement, and you have a 2-minute fair value gap here, combining these two, and gave multiple entries there. I hope this helped and showed you what divergences are, how to recognize them, and how to trade them. Please let me know in the comments below if you enjoyed this. Please like and consider subscribing. Thank you.